Welcome to our channel. Today we're diving into The Intelligent Investor by Benjamin Graham. This book, often called the Bible of value investing, has shaped generations of successful investors. We'll break down key principles that can help you achieve long-term investment success. Whether you're just starting out or a seasoned investor, these principles are essential. So if you're ready to learn how to invest like the greats, buckle up and let's get started. Let's kick things off with the fundamental difference between investing and speculation. Investing, as Benjamin Graham defines it, is all about thorough analysis. You're digging deep into a company's financials and assessing its long-term earning potential. You're looking for companies with solid fundamentals that are undervalued by the market. Instead of chasing quick profits, you're making calculated decisions based on a company's intrinsic value. Speculation, on the other hand, is more about betting on short-term price movements. Think of it like gambling. You might get lucky, but the odds are stacked against you. For the average investor, sticking to a disciplined, investment-focused approach is the way to go. Investing should be about growing your wealth steadily and sustainably. Avoid chasing quick riches and exposing yourself to unnecessary risk. Now, let's talk about one of Graham's most brilliant concepts, Mr. Market. Mr. Market. Imagine you have this business partner, Mr. Market, who's incredibly emotional and erratic. Every day, he offers to buy your shares or sell you more at a certain price. His prices are all over the place. Some days he's overly optimistic, offering sky-high prices. Other days he's downright pessimistic, practically begging you to sell at a fraction of their worth. Mr. Market's mood swings are completely irrational. They're not based on any logical analysis, but rather on his own fleeting emotions and market sentiment. This is where you, the intelligent investor, come in. Instead of getting swept up in Mr. Market's emotional roller coaster, recognize that his irrationality is your opportunity. When he's feeling down and offering a bargain, that's your chance to buy undervalued assets. When he's overly enthusiastic, driving prices through the roof, it might be a good time to consider selling. The stock market is driven by emotions as much as fundamentals. By understanding Mr. Market's unpredictable nature, you can avoid making impulsive decisions. Capitalize on his irrationality to your advantage. Stay rational and make informed decisions. Let's talk about one of the most important concepts in investing, the margin of safety. The margin of safety is essentially that extra cushion you build in when buying an asset. It's the difference between the price you pay and the intrinsic value of that asset. Think of it as your protection against the unknown. No matter how thorough your analysis, there's always a chance you might be wrong. The margin of safety helps you mitigate that risk. By buying assets at a discount to their intrinsic value, you're essentially buying on sale. The bigger your margin of safety, the lower your risk. Chapter 4. Defensive versus Enterprising Investors, Finding Your Investment Style. In The Intelligent Investor, Graham talks about two main types, the defensive investor and the enterprising investor.
Let's start with the defensive investor. This is someone who prioritizes minimizing risk and preserving capital above all else. They're not looking for the next big winner or trying to beat the market. Instead, they aim for steady, long-term growth with minimal effort. Think of it like a slow and steady tortoise. They diversify their portfolio broadly, often investing in index funds, blue-chip stocks, or real estate.
On the other hand, we have the enterprising investor. This investor is more hands-on and actively seeks opportunities to outperform the market. They're willing to put in the time and effort to research individual stocks and analyze financial statements. They still prioritize thorough analysis and risk management, but are more comfortable with higher risk tolerance.
So, which one sounds more like you? The key is to be honest with yourself about your risk tolerance, time commitment, and investment goals. There's no right or wrong answer here. The important thing is to choose an investment style that aligns with your individual needs. Stick to it. Chapter 5. Intrinsic Value, the true worth of a business. When you buy a stock, you're essentially buying a piece of a business. But how do you know if you're getting a good deal? That's where intrinsic value comes in.
The stock market can be incredibly irrational. A company's stock price can fluctuate wildly based on news, speculation, or market sentiment. But intrinsic value is about cutting through that noise and looking at the underlying fundamentals. It's about analyzing the company's financial statements, understanding its business model, and projecting its future earnings potential. Calculating intrinsic value involves making assumptions about the future and using various valuation models. The key takeaway is to buy stocks when they're trading at a discount to their intrinsic value. That's how you find those hidden gems, those undervalued opportunities the market has overlooked. By focusing on intrinsic value, you can make more informed investment decisions.
Chapter 6. The role of risk protecting your capital. Risk is an inherent part of investing, but understanding and managing it is crucial. Risk isn't just about potential losses, it's also about the uncertainty surrounding your returns. A risky investment might have high returns, but also a higher probability of losing money. Graham stresses that minimizing the risk of permanent capital loss is paramount. Avoid speculative bets that could wipe out your savings and focus on investments with a solid margin of safety. Diversification is key. Don't put all your eggs in one basket. Spread your investments across different asset classes, industries, and geographies. This helps reduce the impact of any single investment on your overall portfolio. Thorough analysis is another crucial aspect of risk management. Don't blindly follow the crowd or jump into investments without understanding the fundamentals. Take the time to research companies, analyze financial statements, and understand potential risks and rewards. Protecting your capital is about making informed, calculated decisions. Chapter 7. Market fluctuations and timing. Don't try to predict the unpredictable. Trying to time the market perfectly is pretty much impossible. The stock market is influenced by countless factors, from economic data to investor sentiment. Even seasoned experts can't consistently predict short-term market movements. Instead of trying to outsmart the market, focus on your investment strategy. By investing consistently over the long term, you can ride out market ups and downs and benefit from compounding. Chapter 9. Dividend policy, the power of consistent income. Dividends might not be as flashy as high-growth stocks, but they play a crucial role in a well-rounded portfolio. Think of dividends as a way for companies to share their profits with investors. Not all companies pay dividends. Some prefer to reinvest profits to fuel further expansion. For investors seeking passive income or more stable investments, dividend-paying companies can be attractive. Companies with a long history of consistently paying dividends tend to be more financially stable. Remember, dividends are not guaranteed and can be cut or eliminated during tough times, but they can provide a steady income stream and add stability to your portfolio. Chapter 10. Analysis of financial statements. Unlocking the secrets of a company. Financial statements are treasure troves of information that every investor needs to understand. Understanding a company's financials is like having a superpower in the investing world. It's about digging deep into the numbers to uncover the true story behind a company's performance. There are three main financial statements: the balance sheet, the income statement, and the cash flow statement. Financial analyst. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholder equity. It tells you what a company owns, what it owes, and what's left over for the shareholders. The income statement shows how much revenue a company generated, its costs, and the resulting profit or loss. The cash flow statement tracks the movement of cash in and out of a company. It tells you how much cash a company generated from operations, invested in its business, and raised or repaid in financing activities. Understanding these statements helps you make informed investment decisions. Thanks for watching. If you found these insights from The Intelligent Investor helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and book summaries. See you in the next video.